If every country on earth is drowning in debt, who is actually owed? If every government is a borrower, where does the money lead? And if no one can ever truly repay it, why does the system continue at all? The numbers are staggering by any historical standard. The United States carries more than $38 trillion in debt, the largest figure it has ever recorded. The European Union collectively holds around $14 trillion. Japan approaches $9 trillion. Even nations long considered financially invincible, export giants like Germany and China, or resource-rich states such as Saudi Arabia, carry enormous obligations. This reality feels counterintuitive. Debt implies a lender, yet every major player appears to owe more than it owns. The answer is not simple, and it is not comforting. The modern world is not collapsing under debt. It is built on it. I am the finance historian. And this is the story of how debt became the foundation of global power. Debt is often portrayed as a burden, a mistake, or moral failure. In reality, it functions as infrastructure. Every war fought, every empire expanded, every economic boom and financial crisis rests on an invisible framework of promises, interest payments, and future obligations. Global debt now exceeds $315 trillion, nearly 3 times the size of the entire world economy. This did not emerge from recklessness alone. It is the result of centuries of deliberate design. To understand how the world arrived here, it is necessary to return to a time before credit cards, before central banks, before paper money itself. The concept of national debt was not born in markets or universities. It was born in war. In the late 17th century, England faced an existential crisis. Continuous conflict with France had drained the royal treasury. Traditional methods of funding, taxation, confiscation, forced loans from the wealthy, had reached their limits. The crown was effectively bankrupt. What followed was not collapse, but innovation. In 1694, England created the Bank of England, a private institution designed to lend money to the government in exchange for interest, secured by future tax revenue. This moment marked a turning point in history. Debt was no longer temporary or personal. It became institutional, permanent, and transferable. This system transformed the nature of power. Instead of relying solely on force or taxation, governments could now borrow vast sums up front and repay them slowly over time. Bonds were issued, sold, and traded. Citizens became creditors to their own state. War could be financed without immediate economic collapse. Debt, once a sign of weakness, became a strategic advantage. England did not merely survive its wars. It emerged stronger, wealthier, and more dominant than its rivals. Other nations took notice. France adopted similar mechanisms. The Dutch refined them. Over time, national debt markets spread across Europe. By the time the United States emerged as an independent nation, this financial model was already proven. The American founders understood its power. Alexander Hamilton, the first U.S. Treasury Secretary, recognized that a strong national debt could bind the interests of wealthy creditors to the survival of the federal government. By consolidating state war debts and honoring them fully, the United States established credibility and attracted capital. Debt became the glue holding the young nation together. This shift changed the relationship between governments and citizens. Creditors now had a vested interest in political stability. Financial institutions grew alongside the state. Debt linked private wealth to public power. Over time, government bonds became the safest assets in the financial system. They were used as collateral, reserves, and benchmarks. Entire markets were built on the assumption that sovereign debt would always be honored. As economies expanded, so did borrowing. Industrialization required massive upfront investment. Infrastructure, railways, factories, and later welfare systems were all financed through debt. The 20th century accelerated this process dramatically. 2 world wars forced governments to borrow at unprecedented levels. After each conflict, rather than fully repaying what was owed, nations chose to roll debt forward, managing it instead of eliminating it. The idea of permanent debt quietly replaced the idea of repayment. At the center of this transformation stood central banks. Originally created to stabilize currencies and manage reserves, they evolved into institutions capable of controlling interest rates and creating money. Their role expanded as debt levels grew. When governments borrowed more than markets could absorb, central banks stepped in as buyers of last resort. This ensured stability, but it also changed the nature of money itself. Currency became inseparable from debt. In the modern system, money is not backed by gold or physical assets. It is backed by confidence and government obligations. Every dollar, euro, or yen represents a claim on future productivity. Government bonds are not merely promises to repay. They are the foundation of banking, pensions, insurance systems, and global trade. Eliminating debt would not restore balance. It would erase the scaffolding holding the system together. This leads to the central paradox of modern finance. Governments cannot repay their debts without destroying the system that depends on them. Debt is no longer something to be resolved. It is something to be sustained. Old obligations are replaced with new ones. Maturity dates are extended. Interest rates are adjusted. The appearance of control is maintained. Most government debt is not owed to some distant external power. It is owed internally to citizens, institutions, pension funds, and central banks. Foreign holdings exist, but they form part of a reciprocal web. Nations hold each other's debt, creating mutual dependence. This structure reduces the risk of outright default, but it increases systemic fragility. Debt, in this context, becomes a tool of power. Those closest to its creation benefit first. Those furthest away bear the cost quietly. Inflation, asset inflation, and currency dilution transfer wealth without legislation. The burden shifts slowly, often unnoticed, until living standards erode and trust weakens. This is not an accident. It is the logical outcome of a system designed to prioritize continuity over resolution. Debt built the modern world. It financed empires, innovation, and stability. But it also locked societies into a cycle that cannot be reversed without consequence. Understanding this is not about fear. It is about clarity. History shows that systems built on debt do not collapse suddenly. They evolve, adapt, and eventually transform. What happens when a system designed to manage debt becomes dependent on it? What follows when borrowing stops being temporary and becomes permanent? And what is left when confidence begins to quietly erode? By the late 20th century, debt had ceased to be a bridge between present needs and future growth. It had become the operating system of global finance. Governments no longer spoke about paying it down. Instead, they spoke about sustainability, ratios, and management. The language shifted, and with it, expectations. Debt was normalized. Expansion through borrowing became routine. The system appeared stable, but stability was maintained through increasingly complex intervention. Central banks assumed a central role in this process. Their mandate expanded far beyond their original purpose. Interest rates were adjusted not only to control inflation, but to support asset markets and government financing. When crises emerged, liquidity was injected at unprecedented scale. Money creation became the primary tool for preserving stability. Each intervention solved an immediate problem while deepening long-term dependence. This process reshaped financial markets. Asset prices rose faster than wages. Real estate, equities, and bonds benefited directly from monetary expansion. Those with access to capital gained wealth. Those reliant on income fell behind. The gap widened quietly, explained away as globalization or technological change. In reality, it was structural. New money entered the system through financial channels, not through labor. Inflation became the silent partner of debt. Unlike taxation, it required no vote. It provoked no protests at first. Prices rose gradually. Savings lost purchasing power. Obligations were repaid in currency worth less than when it was borrowed. This mechanism allowed governments to reduce the real burden of debt without openly defaulting. It preserved appearances while transferring costs across society. Historically, this approach has been favored over outright default. Default is immediate and visible. It triggers crises and political consequences. Inflation operates slowly. It stretches adjustment across years or decades. From a political perspective, it is far safer. From a historical perspective, it is consistent. Every major debt-driven system has relied on currency debasement or inflation at some stage of its life cycle. What makes the current era unique is scale and synchronization. Never before have all major economies operated under a unified debt-based fiat monetary system. There is no external anchor, no competing framework offering relief. Trade, finance, and currencies are interlinked. Stress in one region propagates globally. Central banks coordinate implicitly, reinforcing the system together. Despite this, the system remains functional because confidence persists. Fiat money holds value because it is accepted. Government bonds are trusted because repayment is assumed. Markets operate on belief as much as mathematics. As long as participants expect continuity, the structure holds. The risk does not lie in the absolute size of debt. Numbers alone do not trigger collapse. The risk lies in perception. When investors begin to doubt not repayment, but real value, behavior changes. Capital seeks protection. Volatility increases. Policy responses become more aggressive. Each response stabilizes the present while borrowing from the future. This creates a feedback loop. Higher debt necessitates lower interest rates. Lower rates encourage more borrowing. More borrowing increases reliance on monetary intervention. Over time, the system becomes increasingly sensitive. Small disruptions require large responses. Flexibility decreases even as control appears absolute. Power within the structure concentrates. Governments gain flexibility. Financial institutions gain influence. Asset holders gain protection. Those without leverage bear adjustment through inflation and reduced purchasing power. The system does not fail evenly. It redistributes pressure downward while preserving the core. History suggests that such systems do not end with sudden collapse, but with transformation. Debt is restructured, currencies are reset, New frameworks emerge from old ones. Those who understand the mechanics adapt early. Those who assume permanence are surprised. This is not a prediction of imminent disaster. It is an observation grounded in centuries of precedent. Debt has always been both a tool and a constraint. It enables growth while limiting freedom. It creates stability while demanding trust. When trust weakens, the system adjusts. The modern world did not stumble into debt. It chose it repeatedly because the alternatives were worse in the short term. War, stagnation, and collapse were postponed through borrowing. That success created dependence. Now debt is no longer a response to crisis, it is the condition of normalcy. Understanding this reality changes perspective. Debt is not a moral failing, it is a historical process. It reflects priorities, power structures, and trade-offs made over generations. The question is not whether the system will change, but how and who will bear the cost of that change. Those who study history are rarely shocked by outcomes. Patterns repeat, even when details differ. Debt has shaped empires, financed progress, and quietly reallocated power. It continues to do so today. Recognizing this does not require fear. It requires awareness. I am the Signus Salve, I'm a finance historian. And history shows that debt never simply disappears. It transforms the world around it, often long before people realize the transformation has already begun.